Conversation with Aditya Suresh, Managing Director, Head of Equity Research, India, Macquarie Capital. Aditya, great to speak with you. Thank you so much for your time right here on NDTV Profit. Let's first get a slightly broader view. The kind of relief that we're seeing in the markets last few trading sessions, do you see that as more of a kind of a response to the drubbing that we've seen, or now an increasing feeling that Q4 in terms of corporate results will not be as bad as was initially penciled in?
No, thank you for having me on the show. Just to set some context in the backdrop in itself, the broader dynamic of kind of what we kind of outlined in our kind of expectations for this year was that the context was one where expectations were really high on earnings, and that's been a key support factor here for markets. Obviously, domestic liquidity was really strong. Now, in that backdrop, the five kind of speed bumps which we had kind of called out was that one is it's going to be a reset lower from an earnings perspective. There is a momentum slowdown, which you can see particularly in consumer. Obviously, valuations were still excessive. Foreigners were selling. The promoters, PE, VC were selling. So those are kind of the five speed bumps. I think that's kind of playing out. Now, where we are today, are we there yet? If that's a kind of question, I guess our submission is that not quite yet. So yes, there is kind of a respite, and even the pace of foreign selling has moderated. All that is encouraging. But to call it a big inflection for the market at these levels, we're not in that camp, at least in an aggregate sense. And the real kind of key concern here for us is still on this specific point which you kind of mentioned, which is on earnings. Now, is the March quarter going to shape up better than the December quarter? We're not necessarily in that camp, at least given where expectations are at. So when I think about kind of, if I use MSCI India as a proxy, because it's much wider than the Nifty. So MSCI India, the consensus earnings growth expectation 2 year forward is about, say, 14-15%. That still is too optimistic in our mind. Just to draw some reference again, so when you think about the past 3 quarters, right, or even say the last quarter for MSCI India, revenue growth was about 5%. When you think about net profit growth, X of some of the one-offs, it is about, say, 7-8%. And that picture does not really change too much, even if I kind of expand the time period. So we still need a reset lower in earnings expectations. And I think that's still a problem for the market in an aggregate sense. Having said that, given the sharp pullback at a kind of stock level, quite a few more kind of attractive bottom-up ideas here to kind of think about.
Focus on those. The bottom-up ideas that you're seeing, where you think that the pullback is sufficient to give you comfort.
Yeah, so I'm not going to go through specific ideas just on this call here, but that's kind of available in the Macquarie research. But I would just leave it by saying that quite a few, we are finding far more attractive bottom-up ideas at this point in time compared to, say, even 2 months back or 3 months back. And a lot of that is clearly in response to the fact that a lot of these stocks are down 20, 30, 40% from what they were, say, 6 months back. Not to say that the price action on its own is the reason for the attractive kind of position, but so quite a few kind of companies here are interesting, both from fundamentals as well as valuation at these levels.
Aditya, good morning. There are, to my mind, a few conflicting signals out there, and I'm only focusing right now locally. Globally, the picture is very, very mixed. But you know, the IP numbers that came out for Jan looked okay. High frequency indicators per se are looking okay, but the advanced tax numbers that have come out overnight for Q4 are a damp squib, to say the least. Now, and even the corporate advanced tax numbers, right? You knew personal would be bad, but corporate ones as well. What is your own assessment about the economic recovery path from Q2 to Q3? It's been a good number. Does it continue, or does the advanced tax numbers create a bit of a doubt there?
So look, Niraj, I think first is lovely to see you again. But the broader dynamic is that all of us in the market are expecting a further kind of uptick in growth, right, in Q4 and then into kind of fiscal 26 on and so forth. So that's the backdrop. So the way I think about that question is not really about kind of okay, so is Q and Q going to be better, or kind of the year is, are we going to see a better pace of growth? That's already kind of in the baseline, right? So for us to kind of, if the question is framed in the context of what's in expectations in the market, yeah, I think at best we're kind of meeting some of these kind of growth estimates, right? From a earnings perspective. As you say, there are quite a few kind of conflicting kind of signals here in a high frequency. It's not really a clear cut in terms of which direction the economy is kind of shaping up, right? Credit growth in itself, it remains benign if that's kind of one key indicator. The revenue growth, which we're seeing in terms of consumer staples, is moderate, right? Yeah, even the autos data, I mean, there are quite a few kind of mixed signals here in terms of like which segment is really doing well. I know corporates speak a bit more optimistically about kind of a rural recovery. But when I then think about this in the context of real rural wage growth, that's at best neutral, right? So yes, you're negative and that's gone to neutral. So bad becoming less bad, or maybe perceived as a positive, but it's not a big buy signal, right? So I'll give you a few more data points to go through, right? When you look at MSCI and revenue, right, just in the past say 4 quarters, it's kind of like plateaued. When you think about the high-end smartphone shipments as a proxy for the top-end consumer, that seems to have plateaued again. So as you say, there are not. It's not a unanimous kind of. It's not like all signals kind of pointing in one direction, which is strong growth into kind of next year. I take those points.
Now, the other question is therefore, Aditya, for a market or for stocks to do well, a large market or a large economy growing at 6% may not be great, but it gives enough opportunities where specific companies could actually show some serious earnings growth. So when I try to combine that question of mine with the answer that you gave earlier to Tamanna's question about pockets having corrected enough for there to be good bottom-up ideas, are these in the large cap space alone? Or do you reckon that you now find favor with pockets at the broader end of the spectrum too, even if the base hypothesis that growth is plateauing and not picking up substantially?
I think it's in our mind very selective and bottom up. Like I don't generally try to make the characterization of a small caps are bad or mid cap equals bad or growth momentum is coming off, and that's a broad brush, right? So I think it's got to be very selective. So we do have a bunch of kind of small mid cap ideas which we like a lot. In fact, in the recent report, we've kind of put out a rising stars list where a bunch of stocks which could potentially say double here in the next say 2-3 year kind of perspective, right? So there is that side too. Now, having said that, just sticking with the large caps in itself, just to give you some flavor at a sector level. So, for example, with the financials, our analyst is speaking about kind of an improvement in credit growth from current pace of say 11% towards 13. We'll see kind of how kind of credit costs shape up, but at least our analyst is still a bit more optimistic on at least the private bank credit cost side as well. NIMs maybe comes off a little bit, but broadly speaking, in the teens growth, right, for some of the larger kind of banks. Surely, I mean, so underneath this, within the NBFCs, selectively, some of these could be growing much faster than this. IT as a sector, at least our analyst is speaking about, say, 6 to 8% kind of revenue growth in dollar terms, plus margin expansion, right? So this is then in the mid-teens plus as a kind of earnings growth. So to your point, Niraj, I think, yeah, we are going to be finding a lot of kind of areas in the bottom up where you are still going to get a lot of growth. So it's never been like, for example, in a top-down sense, one of the points we make in our recent note is that despite the say 20% kind of pullback, my sense was that as a market, we've gone from say egregious as a valuation to above par, and therefore it's still a rich bazaar for us to think about. But on the bottom up, there's still so many ideas for us to think about and construct an India portfolio, if I may, right? So it's not to say that be structurally underweight India because expectations too high. That's never the conclusion of the message. It's more about bottom up and kind of where we're positioned. I'll give you some more examples of this, right? So like consumer discretionary is a space where consumer discretionary industrials, we're seeing a lot of revenue growth. But that revenue, and so this is a space where we're actually a bit counter consensus to some extent. We're a bit more cautious than where the street is at. But once you've seen the revenue growth, to your point, Niraj, we are seeing margin erosion, right? So even in this quarter, both the consumer discretionary and with industrials, you saw leading kind of sector level kind of revenue growth, but margins were an offset. And so the earnings growth in itself was a disappointment. So you have all these kind of nuances kind of work through. Within the sectors, we end up on a bottom up kind of aggregated. We end up being kind of constructive on financials, IT, telecom, those type of areas is kind of where we end up being positive.
Aditya, just to expand that on the consumption story, are you seeing, some tailwinds there for auto, if at all, or is it quite the reverse? And as more of capex front loading takes place post what has been announced in the budget, do you see some of the infra plays coming back into action?
So, Tamanna, thank you for the question. Now, the way I tend to answer this question is again in the context of what's already in earnings expectations and how those expectations are going to be revised upward, downward is the way I think about it, right? So in that context, when I think about it, let's start with industrials. When you look at what is built into revenue growth for industrials as a category over the next 2 years, it's still a very, very large growth number. And into that, there is a big margin expansion which is already kind of built in. So whilst to the extent that there is a resumption of capex, etc., that'll add a bit more of confidence and visibility to those earnings estimates. If I zoom out and think about kind of what's baked in, I still think that at best we're meeting some of these kind of sector level growth expectations on earnings for industrials, rather than kind of further expanding those estimates is the way I think about it. Not to say that we don't like industrial as a sector. We do have a few ideas here which are really interesting, where there's going to be an uptick in the orders as well next few quarters, which we see. With autos and then even with consumer discretionary, like with autos, again, as Niraj was kind of highlighting, it's depends on which category. Quite a few kind of mixed signals in terms of the vehicle sales data. But similar to industrials, what you'll find with autos and in general, when I think about what's even in our estimates on the bottom up, our analyst has the broader dynamic is fairly good volume growth. And into that volume growth, there's operating leverage driven kind of margin expansion of say 200, 300 basis points. And that's kind of where I'd be more cautious, right? I think to the extent that the volume growth is not going to be as strong as what we're going to see, plus then I guess there's an element of you have slow volume growth and then also margin compression. And so that becomes a bit of a problem statement. That's the aggregate comment. Within that aggregate comment, stocks like say M&M is part of our kind of best ideas list. We still like it. It's going to pull back quite a bit. It still features there. So I think the aggregate comment is a bit different from the bottom up. And we still have a few bottom up ideas in each of these different pockets where top down may not be as clear cut.
Fair call. Aditya, lovely talking to you as always. Thanks for taking the time out. Thanks for that cautious optimism as well. Or let's say optimistically cautious, whichever way I can put it. But thanks for giving us those thoughts. Really appreciate it.